Hello guys, how you doing? Welcome to your market report this morning. Now, I'm going to try to tone it down. I'm going to try to speak very softly, and the reason why is because this microphone on this cam, this is not my computer, this is not my ordinary computer. My ordinary computer I've been using has been having some issues. This is an older computer, and this microphone on this cam is very sensitive. And if I talk too loud, it's not a good microphone. It's very rattly. It's very ratty. But the picture quality is a little bit better. But I guess it's a trade-off. Anyway, let's get right into the market report. Let's open up the charts right here, and let's get started. We're going to start taking a look at the price of Bitcoin first off. It's at 64.54, and we had a move upwards. It went to 67.56, and then it's fell off, but it's starting to look bullish. The market is starting to look bullish. Anyway, cryptocurrency market capitalizations. What we have here is we see a mixed bag in the coins. $211 billion market capital. 54.1% Bitcoin dominance at this point. We see the coins here are, let me see if there's any down much. EOS is down. And Tron is down 2.19% today. Now, Dow Jones today. We're looking at 25,428, and we're up 178 points on the day so far. There's a couple things going on in the markets right now. I think I'll get into them in just a minute. I'm going to run through the markets first and take a look at oil today. It's down 52 cents, 0.72%. $71.26 for sweet light crude. We saw a peak in price of $76.20 back on the 3rd of the month. Now, let's take a look at the silver and gold price. We're seeing an up day on silver. It's up 7 cents so far in the day, but it's no big deal. It's staying in its range mostly. That it's been lately, which is very low in the $14 range. Hasn't taken off yet. Now let's take a look at bonds and rates. We're seeing a mixed bag in the bonds, a real mixed bag. The 2-year is up, marginally it's up. The 5-year is up, marginally. And we're seeing a very, very slight down on the 10-year and the 30-year. Very, very slight down on the 3-month, on the short term. So bond yields are basically trotting in place. Now let's take a look at the U.S. dollar index. 94.87. Now there's downward pressure on the dollar, and I'll tell you why. The Fed, for the longest time now, they've been doing everything that they can to support the dollar. And they're ongoing in these things that they're doing to support the dollar. The manipulation of the price of oil was a big one, and a lot of people, they don't realize how they did this. How they did this was the same way they manipulate the price of gold and silver, was through the banking system. They use the banks as a tool to manipulate the price of gold and silver downwards, and we all know how they do that through paper short contracts, using J.P. Morgan as almost like a proxy to push the price down and suppress the price of gold and silver. But oil, they do the same thing, and how they do it is through investment. What they do is they invest in oil companies that are going to go out and frack and put in fracking wells in the United States to increase the United States' oil production. And what happens then is on the world scene is the price of oil drops. This supports the dollar. Well, they were supporting the dollar for the longest time when they had the quantitative easing program going on. It was all about supporting the dollar. Now, things have changed. Things have changed since they've begun quantitative tightening. Now they're not about supporting the dollar. Now they're about trying to take the heat off the dollar so that the dollar will go down. It's opposite. They've switched. Just like they switched from monetary stimulus to pulling money out of the system, now they've switched to, instead of supporting the dollar, now they're trying to suppress the dollar. And so these trade tariffs, that's what they do. Trade tariffs make inflation because it makes the price of goods higher and you have to pay a tariff. And so what happens is that inflation, that consumer inflation, translates into a weaker dollar. Now, letting the price of oil go up, and the best way to do that is to undermine the dollar by breaking off the petrodollar relationship. This helps to weaken the dollar as well. If they do not weaken the dollar at this point, at this stage in the game, then the dollar's going to fly too high and we're going to have a huge crisis. And also they'll have to stop and back off of their quantitative tightening program, which they don't want to do. And so what they're doing is they're weakening the dollar down. The dollar was like 95. Now it's like 94.91. The dollar's come down a little bit. 97 is the point. That's the mark where we go into an emerging market crisis. The dollar gets too strong, we're in big trouble. What they're doing is they're weakening the dollar. They're doing everything that they can do to keep this system going along a little bit longer and to allow themselves to continue with their quantitative tightening and raising interest rates, because they have to continue with their quantitative tightening and raising interest rates. What they're doing is they're continuing to kick the can down the road as far as they possibly can before finally the whole thing turns over on them, because they know what's going to happen when the whole thing turns over on them. This is going to be a monster of a crisis that's going to be hard to contain. It's going to be something that is like for the record books, because they've kept it. They haven't let it turn over. They should have let it turn over back in 2008 and let the system flush itself of all of this negative market action and let the system reset itself and go through the pain. Go through the pain back then. But instead of, it's almost, I'll tell you what it's like. It's like a drunk, you know? And instead of sobering up and going through the hangover, he's just decided to stay drunk and get drunker and drunker. Well, eventually he's going to face the point where if he's going to have to, he's going to go through the DTs or something now at this point, and that's, which is the delirium tremors, which is another story, but a lot of people know what that is. Some people don't. It's it's when your body needs the alcohol, but it can't handle the alcohol anymore. And that's what's happening with the system. Instead of letting the whole thing collapse in 2008 and letting it reset itself, they kept this whole thing going by monetary stimulus. Now at this point, in this stage in the game, they're caught in a corner. The Fed has painted themselves into a corner where they can't stop the quantitative tightening and raising interest rates. They have to go with it, or the dollar will completely die. And they can't let the dollar get too hot here and go too high right now, or that's going to crash the system. It's almost like they're moving in, moving into a boxed canyon, and they can't go either direction. And this is going to be terrible when this thing comes, because they're reaching the point now where they can't move in one direction and they can't move in the other. It's going to be a crash either way. And so they're closing in on that point daily as we speak. So anyway, thank you guys for listening. Like and subscribe, and we'll catch you in the next market report coming up very soon. Well, tomorrow. Bye-bye for now, guys.